Hi and welcome to this video brought to you by 𝖢𝖥𝖣yi. Today we're diving deep into the Canadian dollar's recent weakness, what's driving it and whether it could continue. The Canadian dollar, or CAD, has fallen more than 8% against the US dollar since 2024 began. That's a significant move for a major currency pair in such a short time. But what's behind this sudden decline? Well, first off, one of the main drivers here is the surprising outcome, or not so surprising outcome, of the US presidential election. With Donald Trump back in office, his administration has proposed a 25% tariff on Canadian goods. His reasoning behind this is to retaliate against what he sees as weak border security and rising fentanyl trafficking. The uncertainty over these tariffs has added downward pressure on the CAD. Now, there's another key factor weighing on CAD: interest rates. Canada's interest rates were at 5% back in May of 2024, but the Bank of Canada has cut rates since then, with the benchmark now standing at 3.25%. Lower interest rates reduce the appeal of holding Canadian dollars, especially when paired with the relatively higher rates in the US. And the Bank of Canada isn't eager to cut again just yet. They're waiting to see how these proposed US tariffs play out before making any major policy moves. Now, let's take a quick look at inflation data, which is another critical factor in CAD's movement. In December, Canadian CPI came in at -0.4% on the month, down from 0%. That's a worrying sign for inflation dynamics, as it suggests that prices are actually falling on a month-by-month basis. Even the trimmed CPI, which is a key measure used by the Bank of Canada, dropped to 2.5% year over year. And this puts inflation closer to the BOC's target range, but it also signals slowing demand in the economy. So what does this mean for traders? Slow inflation gives Bank of Canada less reason to raise rates or even to maintain them, providing yet another reason for Canadian dollar weakness. The Canadian economy is forecast to slow further, with high unemployment still at 6.7%. Combined with the weak inflation we just discussed, the outlook for CAD isn't looking great. This makes CAD a favourable currency to sell against strong currencies such as the Japanese yen. But there is a slight glimmer of hope for those CAD bulls. Did you know that seasonally the Canadian dollar futures market tends to rally from March 25th to May 1st? Over the past 47 years, CAD futures have rallied 65% of the time during this period. So if history is any guide, we could see some upward pressure coming soon. So traders, what's your take on the Canadian dollar? Do you see further weakness ahead, or will that seasonal rally save the day? Let me know your thoughts in the comments down below. If you enjoyed this video, hit that subscribe button and like if you are new.